Hey there, economic thrill seekers. Welcome back to Boss Economics World, your VIP pass to the wild, wacky, and often downright absurd circus of global finance. I'm your host, Boss, here to serve up some spicy economic commentary with a generous dollop of satire. Today, we're diving headfirst into the latest episode of Trump versus the Fed, the Great American Smackdown. Picture this, U.S. Treasury Secretary Scott Bessent is calling for an inquiry into the entire Federal Reserve, Trump is throwing tantrums about interest rates, and the Fed's headquarters renovation is being dragged through the mud like a reality TV scandal. Oh, and did I mention inflation's creeping up, the labor market's wobbling, and the trade wars heating up? Grab your popcorn, or your financial spreadsheets if you're one of those fancy finance pros, because this is going to be a wild ride. We're going to break down the data, expose the economic logic, and predict where this clown show is headed. Spoiler alert, it's not looking pretty, but hey, at least it's entertaining. So, let's get started. Let's set the scene. It's July 2025, and the Trump administration is cranking up the pressure on the Federal Reserve like a kid trying to squeeze the last drop of ketchup out of a bottle. U.S. Treasury Secretary Scott Bessent, Trump's right-hand man on economic policy, dropped a bombshell on CNBC on Monday, July 21, 2025, calling for an inquiry into the entire Federal Reserve institution. His reasoning? We need to examine whether they have been successful. Oh, Scott, bless your heart, successful at what? Keeping inflation in check? Stabilizing the economy? Or just surviving Trump's daily Twitter, X, tirades? This isn't just Bessent freelancing, folks. This is part of a coordinated campaign by Trump and his lieutenants to bully the Fed into submission. Trump himself has been on a tear, calling Fed Chair Jay Powell a stubborn mule and even floating the idea of sacking him, though he later backtracked, saying he'd only do it for fraud. And then there's Russell Vought, Trump's budget director, who's been screaming from the rooftops about a $2.5 billion renovation of the Fed's headquarters, claiming it's $700 million over budget and grossly mismanaged. The Fed's response? A video tour of the buildings on YouTube, like they're trying to sell us a fixer-upper on HGTV. I mean, come on, guys, could this get any more absurd? But here's the real kicker. Trump wants the Fed to slash interest rates to as low as 1%, claiming their current policy is costing the government hundreds of billions in refinancing costs. Meanwhile, the Fed's holding steady at 4.25% to 4.5%, trying to navigate a trade war, rising inflation, and a labor market that's starting to wobble. So, what's really going on here? Is this just Trump being Trump, or is there a deeper economic logic, or lack thereof, behind this madness? Let's dig into the data and find out. To understand this Fed-bashing circus, we need to look at the hard numbers. These aren't just boring spreadsheets, folks, these are the tea leaves the Fed is desperately trying to read to figure out if the U.S. economy is booming, busting, or just stumbling along. Let's break down the key data points and what they mean. First up, inflation. The Consumer Price Index for June 2025 showed prices rising at a headline rate of 2.7%, the fastest pace since February 2025, according to the Bureau of Labor Statistics. Core inflation, which strips out volatile food and energy prices, hit 3.1%, up from 2.9% in May. That's bad news for the Fed, which has been struggling to hit its 2% target since the pandemic, when supply shortages and Biden's record fiscal stimulus sparked the worst bout of inflation in a generation. But here's where it gets messy. Trump's trade war is pouring fuel on the fire. According to the Peterson Institute for International Economics, Trump's latest tariffs, up to 30% on imports from China, Europe, and Mexico, could add 0.5% to U.S. inflation in 2026, pushing the CPI above 3%. And Bessent's response? He's accusing the Fed of fear-mongering over tariffs and claiming the U.S. has seen great inflation numbers. Great for who, Scott? Certainly not for the average American, who's already shelling out 20% more for groceries than they were in 2020, according to BLS data. This is classic Trump world logic: ignore the data, blame the messenger, and hope nobody notices. Next, let's talk interest rates. The Fed cut rates by 1 percentage point between September and December 2024, bringing the federal funds rate down to 4.25% to 4.5%. That was supposed to cushion the economy against Trump's trade war and a slowing global economy. But now, most Fed rate setters want to hit the pause button, arguing that they need to weigh up the impact of the trade war on inflation. Translation: they're terrified of cutting too much and letting inflation spiral out of control, but they're also worried about keeping rates too high and tipping the economy into recession. And here's the scary part: the bond market is flashing warning signs. The yield curve, specifically, the spread between 10-year and 2-year Treasury yields, inverted again in June 2025, a classic predictor of recession within 12 to 18 months, according to Federal Reserve Bank of New York data. Meanwhile, the government's borrowing costs are indeed rising, just as Trump claims. The Congressional Budget Office estimates that interest payments on the national debt will hit $1.2 trillion in 2026, up from $892 billion in 2024, thanks to higher rates and a ballooning deficit. But is that the Fed's fault, or Trump's, with his tax cuts and tariff-fueled spending spree? I'll let you decide, but here's a hint: the Fed doesn't set fiscal policy. Finally, let's talk about the labor market, because this is where things could get really ugly. Fed Governor Christopher Waller, a potential successor to Powell, recently said a weakening labor market justifies a 25 basis point rate cut as soon as next week. And the data backs him up. The unemployment rate ticked up to 4.3% in June 2025, the highest since October 2021, according to BLS. Job growth slowed to just 142,000 per month in Q2 2025, down from 215,000 in Q1, and wage growth stalled at 3.6% year-on-year, barely keeping pace with inflation. But here's the kicker: Trump's tariffs are making things worse. The National Association of Manufacturers estimates that the latest round of tariffs could cost 500,000 U.S. jobs by 2026, as higher input costs squeeze businesses and weaker export demand hits industries like agriculture and manufacturing. So, Trump wants lower rates to boost the economy, but his own policies are kneecapping growth. Classic Trump world logic: create a problem, blame someone else, and demand they fix it. Now that we've got the data, let's zoom out and look at the bigger picture. Why is Trump so obsessed with bullying the Fed, and what does it mean for the U.S. economy? It all comes down to three interlocking problems: political theater, economic ignorance, and institutional risk. First, let's talk politics. Trump's Fed bashing is classic political theater, designed to deflect blame for his own economic missteps. Inflation's rising. Blame the federal. Borrowing costs are up. Blame the federal. The labor market's weakening. You guessed it, blame the federal. Never mind that Trump's tariffs are driving up prices, his tax cuts are ballooning the deficit, and his trade war is killing jobs. In Trump world, the Fed is the perfect scapegoat, because it's an independent institution that can't fight back, at least, not publicly. But here's the problem: this isn't just rhetoric. Trump's threats to sack Powell, combined with Bessent's call for an inquiry, are eroding the Fed's credibility. According to a Gallup poll from June 2025, public confidence in the Fed has fallen to 35%, the lowest since the 2008 financial crisis. And when investors lose faith in the Fed, bad things happen. Think higher borrowing costs, market volatility, and a weaker dollar. Just look at Turkey, where President Erdogan's meddling in the central bank led to a 50% currency collapse in 2021. Is that what Trump wants for the US? Probably not, but hey, logic has never been his strong suit. Second, let's talk economic ignorance. Trump's demand for 1% interest rates is so detached from reality, it's almost comical. Let's break this down. With inflation at 2.7% and rising, cutting rates to 1% would mean real interest rates would be negative 1.7%. That's a recipe for runaway inflation, folks. Think 1970s stagflation, when prices soared, wages stagnated, and the economy tanked. According to the International Monetary Fund, negative real rates for an extended period could push U.S. inflation above 5% by 2027, wiping out savings and hammering the middle class. And here's the irony: Trump claims high rates are costing the government hundreds of billions in refinancing costs, but his own policies are the real culprit. The CBO estimates that Trump's 2025 tax cuts, which extend the 2017 cuts and add new corporate breaks, will add $4.6 trillion to the deficit over the next decade. That's money the government has to borrow, driving up interest payments regardless of what the Fed does. So, Trump's solution to a problem he created is to bully the Fed into creating an even bigger problem. Genius, right? And third, let's talk institutional risk. The Fed's independence is one of the cornerstones of a U.S. economy, ensuring that monetary policy is based on data, not politics. But Trump's attacks, combined with Bessent's inquiry and Vaught's renovation scandal, are putting that independence at risk. If the Fed caves to Trump's pressure and cuts rates prematurely, it could lose credibility with investors, leading to higher borrowing costs and market chaos. And if Trump succeeds in replacing Powell with a loyalist, say, Kevin Hassett, who's reportedly in the running, it could turn the Fed into a political puppet, undermining its ability to fight inflation or stabilize the economy. Just look at history. When President Nixon pressured Fed Chair Arthur Burns to keep rates low in the early 1970s, it led to double-digit inflation and a decade of economic misery. According to a 2023 study by the Federal Reserve Bank of St. Louis, central bank independence is strongly correlated with lower inflation and higher economic stability. So, Trump's Fed bashing isn't just a sideshow, it's a dangerous game that could have real consequences for the U.S. economy. So, where does this leave us? Let's play fortune teller and sketch out three possible scenarios for the Fed and the U.S. economy. In the best-case scenario, the Fed stands its ground, keeping rates at 4.25% to 4.5% through 2025. Inflation stabilizes around 3%, the labor market softens but avoids a meltdown, and Trump's tariffs don't escalate into a full-blown trade war. The Fed's independence is preserved, and Powell rides off into the sunset in May 2026, leaving the economy in decent shape. Probability? I'd give it 30%, because let's be real, Trump's not known for backing down. In the most likely scenario, the Fed caves to Trump's pressure, cutting rates by 25 basis points in September 2025 and signaling more cuts to come. Inflation spikes above 4% in 2026, forcing the Fed to slam on the brakes with rate hikes, tipping the economy into recession. Trump replaces Powell with a loyalist, eroding the Fed's credibility and sparking market volatility. Probability? I'd say 50%, because the Fed's already showing signs of cracking, with Waller and others open to cuts despite rising inflation. In the worst-case scenario, Trump escalates his attacks, sacking Powell and launching a full-scale assault on the Fed's independence. Rates are slashed to 1%, inflation spirals out of control, and the dollar tanks, losing 20% of its value against major currencies by 2027, according to IMF projections. The U.S. economy plunges into stagflation, with GDP contracting by 1% in 2026 and unemployment hitting 6%. Probability? Let's call it 20%, but if Trump's track record is any guide, don't bet against chaos. Alright, folks, let's wrap this up with some boss-style straight talk. Trump's Fed bashing is a clown show, but it's a clown show with real consequences. Politically, it's a masterclass in deflection, blaming the Fed for problems Trump created. Economically, it's a disaster waiting to happen, risking runaway inflation and a weaker dollar. And institutionally, it's a direct attack on the Fed's independence, threatening the stability of the U.S. economy. For you finance pros out there, here's the actionable takeaway: hedge against inflation, short the dollar, and keep an eye on those Fed minutes. They'll tell you more about the central bank's spine than Trump's tweets ever will. And for you everyday viewers, here's the bottom line: Trump's economic policies are a mess, and his Fed bashing is making it worse. So, buckle up, because this ride is about to get bumpy. That's all for today, folks. If you enjoyed this economic roller coaster, smash that like button, subscribe, and ring the bell for more Boss Economics world goodness. Got a hot take on Trump or the Fed? Drop it in the comments, I read them all, even the crazy ones. Until next time, stay savvy, stay skeptical, and keep laughing at the absurdity of it all. Boss out.